consumer price index rose just 1/10 of a percentage point in April. That's matching forecasts, while core CPI, which excludes food and energy prices, rose 0.3%. That's ahead of estimates. Now, the Federal Reserve has made it clear that it won't raise short-term interest rates until the Fed is reasonably confident that inflation will move back towards its 2% target. And while the CPI isn't the Fed's preferred inflation gauge, central bankers seem to have an inflation problem. So let's bring in Bob Johnson, Director of Economic Analysis at Morningstar. And Bob, whether it's the Fed's minutes report, which were released earlier this week, or their statements, the Fed seems to acknowledge that inflation is below target, but they also say that they're confident that inflation will improve, and yet we're still seeing this weak inflation. So what's going on here? Does the Fed have an inflation problem?
I don't really think so. I think there's some from the Fed watching standpoint in inflation, I think the inflation rate looks a little bit higher. The core inflation rate, as you mentioned, was up 0.3%, and that would annualize to something over 3%, which is kind of above their target. And even if we take another step back and say, let's not look month to month, which goes up and down a lot, but let's look year over year. And then inflation is down, in other words, deflation of 0.2%. But again, you toss out the energy component and food, and you're up 1.8% on the core, which is kind of getting close to that 2% target that they have overall. And keep in mind on the year-over-year numbers, what's going to happen in the months ahead is that the gasoline benefits begins to roll off. In fact, gasoline prices are now up the last couple of months.
Yeah. But Bob, we're not seeing any wage inflation. What about wages?
Yeah, interesting question. I think on the wage standpoint, there has been some growth in wages, believe it or not, and we're kind of at the 2% level or so on a year-over-year basis. And so it's not awful, and that number has never been a really, really high number. We've gotten some benefits from people going out and borrowing money. We've had benefits from import-exports.
Yeah.
We've had benefits from women going back in the workforce. Wage growth has never been very, very high for the last 50 years.
Yeah, all right. And of course, we have Fed Chair Janet Yellen speaking on Friday. And what do you think the Fed is doing right now? I mean, it seems like they're holding off on a rate hike until at least September, possibly even later.
Right. And I think the key thing, maybe not so much as the inflation report as we had today, but just overall, there's been a few signs of economic weakness. Really, the retail sales reports have not gone up. Consumers really aren't spending very much. Things are a little weaker around the world, and so I think they're a little bit concerned. Gee, why should we be raising rates when growth really isn't accelerating here? Yeah. They're kind of saying in background that, well, we think maybe it's just the weather, but for example, the April retail sales number was weak, and that isn't all about weather. And so I think they're very concerned, and they don't want to raise rates with all the other economic indicators actually showing a little bit of weakness.
Yeah, Bob, let me ask you this. I mean, if you had to play Fed chair, what would you do based on what you're seeing in the economy? What would prompt you to pull the trigger now versus in September versus in 2016?
Yeah. I think I would certainly be watching the real economy. I mean, that's what they're really trying to control here. And if the economy accelerates, as soon as it does, they should begin to tighten. These are very abnormal policies and that we have with all this easing that we've had and these abnormally low rates, and that you don't want to maintain them forever. You want to get rid of them as soon as you can. They're distorting the market and they're hurting savers. So they want to kind of get out of the game of keeping rates unnaturally low, but on the other hand, they've got to keep a very, very close eye on the economy.
And you would raise rates
when? We'll all be doing. I think I'd be raising rates in September would be the most likely standpoint for me.
All right,
by
Bob.
June, it's not going to be clear enough what's happening.
All right, Bob, we have to leave it there, but thank you very much for joining us.
Thank you.
I'm Scott Gamm, and you're watching The Street.